During one of our previous conversations, you outlined 8 or 9 reasons why you felt that banks had failed in Florida during this Great Recession. And one thing you said was that there were too many banks that were chartered during this period from 2000 to 2008.
If you look at the number of banks since the post Barnett acquisition and Nations Bank and that consolidation, Bank of America with Nations Bank and with Barnett, and you look at that period, it left a huge void for the community banks in the neighborhoods, and the prices that banks were getting at the time were so attractive to investors that it led a lot of people to say, let's go find a banker, let's go get a charter. And you know, a lot of banks were chartered with a very high capital level. Some banks as much as $30 million. Some banks, I think the minimum at the time might have been $12 million. And when you think about all of the banks that were chartered from 2000, 2001, 2002, 2003, up until the crisis hit, say in 2006, I think those were the banks that you could say had the higher majority of failures than the established banks. And so one has to ask, was there really that much management talent and management experience coupled with, and this is a big point, I think, coupled with director experience? How many banks started with only 1 or 2 directors that really had bank experience, bank director experience? And so when you look at all of those banks that started up, and you think about management experience, had not been through an economic downturn, had been, for the most part, insulated from that. And then you look at the banks that were led by directors who had very limited bank experience. You can see that there might have been too many banks chasing too few good deals, and so there was an increased intensity to try to reach a little bit.
You mentioned also that one of the problems with banks at the time was their compensation practices for loan officers, that loan officers were rewarded by the volume of the loans that they produced rather than the quality of those loans.
The compensation, every practices that banks employed at the time, for the most part, incented the bankers and the bank management and the executives based on growth, based on production, and not based on credit quality. And so to this day, it's still a really tough decision to have a guy who's really good and whose only concern is volume and has no check or no real backup to what the credit quality is. And so might have been during that time that there was not a division of responsibilities where you had the folks that were approving the loans were not compensated for growth. They were compensated for quality, and the people that were generating the loans and processing the loans and being the front people of the loans, those were the people who were the rock stars of the day, and they were the ones who were highly compensated. And I think it's been shown that there was not enough division of responsibility, so that you had the credit people who did not get conflicted with the relationship, did not get conflicted with who the loan was to, did not get conflicted about how pretty the project looked and all of the pro formas, but they had to look at the pure credit metrics. Not enough of that was isolated, so those could make really, really good decisions.
What were
compensation practice? Well, some banks, one that I'm familiar with, there were lenders in that bank that had a $50 million loan production requirement, and if they did $50 million, then their salary was safe. For every dollar over $50 million they started getting 1% of that, and so many times bankers made 25, 30, 40, some 50% of their salary just in commissions for loan growth and loan production, and that's probably a thing of the past now. I would equate it to a football term. They outkicked their coverage. State banks can lend up to 25% of their capital. National banks can lend up to 15% of their capital in certain situations. And you had a lot of state community banks making very large loans in markets that they weren't in. For instance, you would see a community bank that might have been a year and a half old, 2 years old, making a $10 million hotel loan in a market that they weren't in, a market that they did not know. And if you look at the banks and you look at the failure, I would say a highly probable failure rate were those loans that were in the markets that the banks were not in. They did not have directors, they did not have lenders, they did not have management that knew what the dynamics of that market were. And so hotel loans and loans that they had really no business making, nor the expertise to make. Coupled with director oversight of banks that allowed concentration levels to get too high, allowed loans that had no business being in the bank to get approved. It was the large loans in the banks that caused the community banks to fail. It wasn't the small loans. You didn't see fraud in the small loans. You saw fraud in the large banks. And so directors who knew that there was some drama or some noise in a borrower's past or something, had a fiduciary responsibility to speak up, and I'm not sure they did that.
You said that banks that it was difficult to find really good bankers who had been in the business for 25 to 30 years and had experienced all the crooks and what they could do to a bank.
Let me tell you, there's some really smart guys that were running some really well-capitalized community banks that have failed. And 25 years might have helped, but I would tell you just knowing how the economy did and knowing how that we have an unprecedented deflation in the value of the underlying collateral, and really not ever estimating that we would have borrowers and guarantors flee their responsibilities. There are several in Sarasota, won't mention their names, that were highly successful, highly thought of, well thought of, that when it came time for them to honor up and pay their obligations, they found it inconvenient, and they used actions in the courts to kind of stiff-arm the banks. And some of those guys are around doing well. Some of those guys are living on boats in San Diego, and they found money to buy a big boat they can live on, but they didn't find the money to pay the banks back.
You mentioned before that regulators were late to the party, that they criticized bankers for problem loans and over-concentration in loans to real estate developers after the point when those banks could actually do something about that.
The regulators have a very tough job to do. For the regulator to start questioning and start criticizing a bank's performance in an economy like we were all involved in 2004, 5, and 6, and start raising questions and starting to put up caution signals, it wouldn't have been long before they would have been the most berated group of people in the country. So they have a very tough job. Things that they didn't maybe capture early were the same things that caused the banks to fail, were the basic metrics of what was going on in a very macro sense of the economy. In Florida, we had a 1.5% growth rate per year, maybe at the tops. In 10 years, we might have grown 6%, but at some years we were growing 1% in population, but yet home prices were increasing 20% a year, and building permits were increasing 15% a year. So how do you say that there's a sustainability during that period, and say that when you have a population only growing a 1 to 1.5% at the maximum a year, and building permits are growing 15%, and that's going on for 4 or 5 years, who's buying those homes? Nobody really stopped to measure that, and nobody really stopped to think about that. And I think the regulators have done a better job and are more informed and are more in tune to those sort of macro metrics, if you will, than they were then. And so if they missed something, it was the same thing that the banks missed. But remember, the banks were having record profits, the banks were having record capital levels, the banks were enjoying good growth and good solid asset quality. Past dues were at an all-time low, but it was external factors that contributed as much as the local factors.